Good morning, everyone, and welcome to the Q2 2026 edition of the Blackfinch Aim in Focus webinar. Before we begin, it's important to note that the content of this webinar is intended for the professional advisory community, and so the details covered today are not intended to be taken as financial advice itself. As always, if you'd like to submit a question prior to the webinar for us to discuss, please use the contact information contained in the sign-up page or simply email eventswebinars@blackfinch.com. The beginning of Q2 saw a substantial recovery following the AIM market's decline towards the end of Q1. This was largely due to progress in resolving the conflict in the Middle East, which had a knock-on effect on the UK economy and interest rate expectations, as we'll cover in more detail. Despite valuations recovering, we've seen multiple takeover offers throughout the quarter as bidders anticipate further growth, which we'll cover for both our growth and income portfolios, before providing our outlook for the AIM market. I'll now hand over to Lawrence Campin, Senior Investment Manager at Blackfinch AIM.
Thank you, Dave, and good morning, everyone. Following on from Q1, the conflict in the Middle East continued to dominate market sentiment this quarter. Early April saw a strong, broad-based recovery for AIM shares as signs of diplomatic progress began to emerge, and traffic through the Strait of Hormuz was increasing. By the middle of April, a ceasefire had been announced and the strait declared open for commercial traffic. However, markets remained volatile as both sides continued to carry out attacks despite the ceasefire throughout the first half of May. This led to steadily increasing UK interest rate expectations during the period, as well as a rising 10-year gilt yield shown on the chart. This began to reverse as further negotiations took place, eventually leading to a Memorandum of Understanding being announced on June 14th, and thereby a toll-free opening of the Strait of Hormuz. Oil prices followed a similar pattern during the period, finding quarter highs during intense fire around late April, before falling significantly during the diplomatic progress in late May, and then further after the peace deal was signed, leading to a low of $72 towards the end of the quarter. This was at a similar level to the pre-conflict price and has helped to reduce expectation of interest rate rises compared to at the end of Q1. Despite the Memorandum of Understanding, violations have continued on both sides, ending the quarter with renewed uncertainty that is still ongoing and causing a slight uptick in interest rate expectations. We will continue to monitor the situation closely, but note that our investee companies have limited direct exposure to the Middle East. Moving on to M&A activity in Q2, we have ongoing takeover situations in both our growth and income portfolios. Starting with the growth portfolio is Advanced Medical Solutions, an independent developer and manufacturer of surgical products and technology in the global healthcare industry. Now in June, H.B. Fuller, a trade buyer and specialist in adhesives and chemical products, reached an agreement on a recommended cash offer at 285 pence per share, representing a 35% premium to the understood price. This follows multiple takeover approaches by private equity over the past couple of years, which the board have rejected previously on valuation grounds. During this time frame, Advanced Medical Solutions has successfully restructured its wound care business by shifting focus towards higher margin products. The business has also achieved cost savings and improved operating margins by carrying out the integration program of Peter Surgical, a business they acquired in 2024. We believe that the takeover price represents fair value and will enable us to reinvest the proceeds into other attractive growth companies on AIM in due course. Another investee company in our growth portfolio is Accesso Technology, which in our view could be considered a future takeover target. Accesso is a UK-based technology provider that offers highly embedded, patented technology to thousands of leisure attractions and venues worldwide, such as the likes of Six Flags and Merlin Entertainment. Performance has been challenging at Accesso, with struggles against persistent macroeconomic challenges that have limited footfall at end customer venues, impacting transactional revenue. A non-renewal of part of an existing client agreement has also had a negative impact. However, change has been ongoing at Accesso, with the appointment of Lee Cowie in May, a new and highly experienced CEO, who was previously Chief Operating Officer at Accesso, and prior to this was the Chief Technology Officer at Merlin Entertainment. We expect Lee is well placed to progress the company's AI strategy, which has already seen material cost efficiencies from the integration of AI across multiple parts of the business. This position was further strengthened with the recent acquisition of Dexibit, an AI and data analytics platform, which should be well placed to unify venue data and enhance with external signals. We believe that the valuation of Accesso is materially below intrinsic value, and note that in early June, Constellation Software, a prolific software company acquirer, joined the shareholder register with a 3.2% stake. The share price of Accesso responded, up 22% on the day of announcement, and we will continue to monitor any future developments closely. We have also experienced takeover activity in our income portfolio this quarter, with the recommended cash acquisition of Ramsden's, a diversified financial services provider and retailer that we have held since initial listing in 2017. The offer came from Texas-based pawnbroker First Cash Holdings for a cash consideration of 600 pence per share, representing a 33% premium to the undisturbed price. While Ramsden's financial performance and share price has benefited from the rising gold price in recent years, as shown on the chart, we also believe Ramsden's experienced management team has moved the business forwards operationally. This includes through the opening of new stores across the UK, with expectations of 10 to 12 new stores this year, improvements to Ramsden's online presence, and maintaining a disciplined M&A policy. It has also been pleasing to see shareholders have been rewarded along the way with rising dividends. First Cash acquired Ramsden's main competitor, H&T, last year for a forward price to earnings multiple of 12 times. This compares with just over a 13 times multiple for Ramsden's. Overall, we believe that this offer represents a strong outcome for shareholders, and subsequently decided to sell the majority of our position and reinvest the proceeds into other attractive and cash-generative companies on AIM. One investee company from our income portfolio that we believe could be a future takeover target is Virtue Motors, who are in the motor retail business and focus on the sale and servicing of vehicles. With 191 sales outlets and 35 franchise partners, they hold a strong position as the fourth largest motor dealer in the UK. Despite the UK automotive industry facing multiple headwinds, such as the rising cost of living and the challenging electric vehicle mandate requirements, management have protected the business through cost efficiencies, including the reduction of headcount, rebranding their subsidiaries under a single name, and closing showrooms on Sundays. These cost reduction programs have been alongside portfolio changes that include selective sales of underperforming freehold properties, while opening further Chinese EV dealerships. The company has also maintained a strong freehold property-backed balance sheet. Now, in May, CAG Vega 2, a subsidiary of the Constellation Automotive Group, increased their holdings in Virtue Motors significantly from 11% to a 19% stake. Constellation purchased these additional shares for 86 pence, which represents a premium in excess of 30% compared with the previous close price. Constellation has a large portfolio of holdings in the automotive industry, with established names such as Cinch, We Buy Any Car, and Marshall Motor Holdings, which they have added over recent years. So we believe that Virtue could represent a potential takeover opportunity going forwards for Constellation, and we'll look to monitor the situation very closely. Now, moving on to the outlook for AIM, volatility in UK politics has been a theme for the year to date. However, it is expected that Andy Burnham will be announced as the new Prime Minister in the near term. Now, as can be seen on the chart from Polymarket, the probability is just under 100%. So while his policies are yet to be determined, we note that the bond markets have so far had a fairly muted reaction to recent interviews, which included Andy confirming he would not look to break the fiscal rules that are in place covering government borrowing. We will be looking for further clarity on the direction of spending and taxation and the impact this could have on portfolio investee companies. In order to limit the uncertainty of any upcoming policy changes, scheduling an autumn budget for this year to be sooner rather than later would be a sensible move in our view. So while the outlook for AIM and the UK equity is mixed, with low economic growth and uncertainty remaining on the trajectory of inflation with the war in Iran ongoing, the position has improved over the past 3 months. The International Monetary Fund, or IMF, recently upgraded its GDP forecast for the UK, raising the UK GDP growth estimate for 2026 from 0.8% to 1%, and they left 2027 unchanged. As we previously noted, while forward-looking interest rate expectations have been volatile, they are currently materially below the peak, and valuations across AIM do remain attractive, highlighted by the volume of M&A in the year to date. We continue to believe that the medium-term outlook for AIM is positive, which is likely to involve a more stable backdrop, including less volatility around interest rate expectations, which should be more conducive to equity investment. So with that, I will pass back to Dave for the wrap-up. Thank you.
Thank you, Lawrence. Now that's everything for the Q2 2026 AIM in Focus webinar. So thank you, Lawrence, for joining us today, and to all of you for tuning in. As always, should you have any questions off the back of today's content, feel free to contact your dedicated business development manager. Each webinar will be held on the third Thursday of every new quarter, meaning the next will be Thursday the 15th of October at the same time at 9:30 AM. We look forward to seeing you there. Bye for now.